McLennan is here. He's co-head of the global value team at First Eagle Investments. He's the lead manager of the Morningstar 5-star rated First Eagle Global Fund, which is up about 7% year to date. Matthew, it's good to see you again. And, I don't want to make it sound like you're coming in here just to explicitly make this warning about a sovereign crisis, but tell me why this is on your radar now.
Well, it's on my radar because every time you see a bank failure, it is a bit of a flash warning that there may be some systemic issues out there. And you need to look at where the banks are experiencing their loss problems. And the interesting thing this cycle is it's in sovereign securities and mortgage-backed securities, which are essentially backed by the sovereign. And it's also, coincidentally, the area where we've seen the greatest amount of debt growth this cycle after all of the post-COVID stimulus. And so we're sitting in a situation where the irony is for banks that sovereign debt is deemed to be something that requires zero risk weighting, because it doesn't have the same credit loss profile. But it does have duration exposure, as we've seen. And there are many examples throughout financial history of dramatic losses in sovereign paper when there's bouts of unexpected inflation.
So just kind of looking through the problems here, we have large deficits, obviously, large current account deficits, kind of always following the channel to make sure there's enough foreign demand for securities, which there kind of always seems to be. Against this backdrop, though, is it true that gold is one of your top holdings? And yes, it's getting a lot of attention lately, but is this something you think is going to demonstrate outperformance, or is it simply a store of value against the dollar, or what else you see playing out here?
So gold is an important hedge for us. And the key issue with sovereign risk is that if you can't chart a course back to fiscal balance, and it's hard to see it right now because we have these big deficits at a time of full employment, then you risk confidence in the currency. And obviously gold is a sound hedge against currency weakness. The other thing I'd say is that the U.S. requires foreign buyers because of its current account deficit. When we sanctioned Russian reserves last year, that probably produced a question mark for a number of potential foreign buyers. And what we've seen over the last year is that foreign central banks have stepped up their pace of gold purchases in the wake of that decision. And the other thing I would say is if you're the fiscal authorities in the United States right now, you're presented with two difficult paths. You can either embark on a program of fiscal tightening, but that would tip the economy into a deeper recession ahead of an election year. And so that seems unlikely. Or you can leave the fiscal spigots open as they are and risk a stagflationary environment like the 70s. Either recession with lower real rates or a stagflationary environment has been a pretty good backdrop for gold as a hedge asset. And, I would just make the further argument here that even though gold is near its nominal highs, relative to the level of U.S. money supply over the last 50 years, or relative to the level of global equity valuations over the last 50 years, gold is still trading below its 50-year averages. And so we typically don't see gold peak out until the 2-year rate is troughing out, and it's only just rolled over. So we don't try to call these things with precision, because you can't. We recognize that gold is there to protect against the potential lost decade in stocks. But it is the case that there are a number of factors that could support gold as we look out over the next 12 to 18 months here.